Well, thanks everybody for joining us on a, hey, we want to listen to the community. There was a desire to have this done, after hours. So that's what we are doing tonight. And as usual, this is your time to ask questions, and we'll dive into them. There's nothing you can't ask. We do have some questions that were sent to us earlier, and we're gonna dig into those at some point. But just want to let you know, if you've got questions, we want you to type them in the chat box, or
raise your hand,
and we'll call on you, and we'll unmute you, and you can do what you would like to do. So all right, is anyone got any questions they want us to jump off? We know that, listen, there's some of you that don't even know what IBC stands for. That's okay. There's other people that are saying, hey, can you dig into this little thing of the book? We can absolutely do that as well. But Jim, if you want, we've got some questions here, and let's dig in. We'll jump right on in, and I'm gonna pull up this list that we had emailed to us by a friend of ours this morning. So, all right, Jim, this is one we get a lot.
Okay.
And it is, how is guaranteed versus non-guaranteed determined? So this is someone looking at the illustration, and we know we got a couple columns, and so why don't you dig into that?
Okay, so that's a great question, and I'm going to answer that question, but I'm going to talk about illustrations a little bit. Is with other types of insurance, like universal life policies, it shows a projected value. And what is that projection based on? It's not based on history. Sometimes it's based on history, but like at the market, but it's normally based on some projected interest rate, indexed universal life, that it's going to perform at a certain indexed rate, and that it's not guaranteed. It's not even, there may be a floor of 0, but it's projected. It doesn't even mean that that's what it's paying now. It's just saying, well, here's what I think it might pay for the remainder of the contract, or the life of the contract, I should say. Or it's something that I think you need to see so that you'll buy this universal life policy because it looks really good. Okay. And the insurance costs and everything else aren't guaranteed. In a whole life policy, you have 2 columns, very basic. In the actual illustration, you have a guaranteed column, which is the worst case scenario, just as it says, it's guaranteed. And companies have to create reserves and have enough reserves to pay those guarantees. Okay, so it truly is worst case scenario. Then on the other side, you have current values. Okay, so it's the current market. And the current market right now, what you're looking at in most 2022 illustrations is the end of 21, and is when the dividend was declared, and the lowest interest rate environment we've seen forever. I mean, in a sustained interest rate environment. So what does that make up, that current dividend? Well, what happens is the insurance company calculates how much it's going to cost them for the policy, and they calculate mortality costs, they calculate interest that they're going to earn, and expenses. Now, they always build in a fluff factor of 20 or 30%. Like, well, I'm sorry, not 20 or 30%, 20 or 30% of the return. So there's always a little bit of a fluff factor. And what they're saying is, hey, we did better than we thought we were going to do in mortality experience, expenses of the company, and our investments, and what we earned on that general account. So we're going to declare a dividend. Now, if they declared everything that was extra, that wouldn't be very prudent. Now, there are companies out there that are very aggressive with those dividend projections, and they're paying out just about everything in the current year. That can come back to haunt them because they have to keep a certain amount of those dollars in reserves. So the guaranteed is just like it says, the guaranteed. The current market is the dividend is declared after analyzing those three, what experience they had over the year in those three categories: mortality experience, interest that they earned on the general account, and then expenses of the company. So those are the three factors that make up the dividend.
So on the guaranteed side, so there's a lot of people that look at the future of the economy, the world economy, and some with a lot of uncertainty. And I think if we could look back, if we went back some period of time, 5, 10, 20, pick your time frame, right?
Yep.
There's a whole lot of similarities to right now. There's always this uncertainty factor, right? Now these insurance companies, they have a ton of experience, right? They have actuarial data on this side. They have selection. They have a law of large numbers. These things that make them pretty stinking reliable, right?
Absolutely.
But when we look at the uncertainty of these times, and if we were to go back, Jim, would you gravitate towards wanting something that had relatively high guarantees, or would you want to kind of be betting on, that they're going to be continue to be correct, and because we see this a lot, right?
Yeah. We see companies that are aggressive with their dividends, and then we see companies that have high guarantees. And I could draw out for you just the guaranteed values, and your IBC program, your IBC system would be fine. Especially the way that we teach it at CreateTailwind, which is we want you to eventually buy cash flowing assets. And when you do that, you could go off of just the guaranteed values, and your system would be super efficient. And it would in a few years, it will be paying for itself from those assets, and those assets will be growing, keep up with inflation, everything else. I could use just the guarantees and you'd be fine. So just know, if it was worst case scenario and they never paid a dividend, the IBC system that you're building will work.
Yeah.
Right.
So it's kind of like, I know this isn't as extreme as if we were using a different life insurance chassis, but it's like, hey, if I'm building you a banking system, do you want one where failure is an option or not an option?
Right.
And it's not that a non-guaranteed is going to create where failure is an option. It's just, I want the most bulletproof thing that I can get my hands on.
There's a lot of illustrations out there on the internet, and you have these marketers, and they're great marketers. They really are. I mean, they're better marketers than we are. But we're going to tell you the whole truth, and the whole truth is that if I show you a direct recognition illustration, and I show you not taking any loans in that illustration, but I know that when you take a loan, it's going to reduce your dividend. Well, then to me, that's deceptive, right? And I won't show you taking loans in an illustration, but I also will show you non-direct recognition, which means your dividend will not change. The policy, if the current dividend stayed the same for the entire life of the contract, this is what it would look like.
Yeah.
Okay. So, excuse me. Dividends are going to change. So what do you need? You need an in-force illustration. So if you just buy an insurance contract from your local insurance agent that doesn't really know anything about infinite banking, and you call them every year that the dividend changes and you say, hey, I want to get a new illustration, they're going to say, well, why? Also, I want to get an illustration showing that I paid more PUA back on this loan than I was going to when you gave me the original. You're going to blow their mind. They're not going to know why you want that illustration. So it's really important that we do infinite banking every day. We teach it every day, and we don't want surprises, right? Yeah. I mean, I don't want direct recognition because I don't want surprises. I want to know what's going to happen. I know taking that loan is not going to affect my dividend.
Yeah. All right. Thanks. Well,
That was a bonus answer to a question that wasn't asked.
but it's something that is getting danced around a lot, and people don't always understand what they're asking. But
the filter gets a lot thinner at 8:00 at night. I mean, normally during the day, I'm trying to be nice. No,
all right. So the second question: what happens to cash value at death benefit at death?
So, I mean, you have two columns that you're looking at. You have death benefit and you have current cash value, right? And when you graduate from this world, your family will get the death benefit minus any loans that you would have, right? But it's kind of like, think of it, and people would say, and you can get this, again, a marketing thing. You can get a universal life policy where you get the cash value and the death benefit. Okay. Now, you can't keep it for your whole lifetime because the increase in mortality costs will kill you. Not literally, but it will kill your pocketbook. Okay. So you can't really do that. But think about it like a mortgage. When you pay off your mortgage, you don't get all your money back and the house.
Yeah. When you sell the house, you don't get to keep the house and the money.
Right.
Right.
Yeah. So you're being charged for the difference between the cash value and the death benefit. I mean, it's planned out that way. I mean, it's not technically every year they're calculating it, but that it's projected to be the corridor, meaning between the death benefit and the cash value gets smaller and smaller and smaller the older you get.
Yeah.
So
at death,
percentage wise.
Yeah. If a whole life policy endows,
right.
Okay. So that means you win. All right. So if you live to be 121,
I'm almost halfway to endowment.
The insurance company will send you a check for the death benefit. But
which you don't want because it'll be a taxable event. Okay. So,
but here's the thing. All those years, what do we get? We get to bank with that cash value. Yeah. And that's really, listen, if you haven't watched the equipment financing example in the Becoming Your Own Banker course, if you haven't watched the first video in section 3 of the Becoming Your Own Banker course, the CD sister versus the IBC sister, then you have to watch those two. Jim and I just recorded a podcast. I think it came out this week. It was us digging into the equipment financing example.
A different angle.
Yeah. And that's the point of infinite banking. It's not this stagnant thing, this piece of paper that I keep putting money on the shelf with. It's, hey, I've got to put it in motion. So that's an expanded. All right. Question. Since I've been hearing reports of other insurance agencies having a large uptick in deaths recently, more than is usual, I was wondering if the insurance broker who backs CreateTailwind has been seeing a sharp increase in deaths as well. Well, great question. We talked about it this morning.
We talked about it this morning. That's right. And there's a couple of people on the call from this morning, and that's cool because so what this was one insurance CEO with a company called One America, which we're contracted with. If you are rated, they're very good. They have this rider that we can make you almost look standard, by the way. Okay, I'm just, we know what companies, we know all of these companies. We're not tied to any of them. So I can tell you about all of them. And I'm not saying anything bad about the CEO, but he said something that was
taken out of context.
It was taken out of context.
Yeah.
And what it was is he said there was what did he say, 40 or 50%?
Well, I think he actually used 20% in the quote.
Okay. So he said, it doesn't matter.
But it's been butchered.
Yeah, it's been butchered. And now people are saying there's a 50% increase in mortality and all this other stuff, right? Okay. So this was on their group insurance block. So group insurance. Now think about everybody at your office or when you used to go to an office and we're just taking everybody. Okay. There's no underwriting in group. Everybody's in. Okay. You could be running an Ironman or doing an Ironman triathlon. And the person down the hall that's eating the box of Krispy Kremes, you guys get the same rate.
Yeah.
Okay. There's no underwriting. There's no underwriting class. So 18 to 65. Okay. 18 to 65. By the way, that's when they want to sell you term insurance, 18 to 65. And the reason is that less than 1%, it's a lot less than 1%. It's actually, I mean, I've seen numbers that below like 57 or 58 or 59, it's like less than 0.1% of term policies ever pay. So that means group term policies, they had a 20, 40, 50% increase in mortality. That means it went from nothing to a little bit more than nothing. And I'm kidding, but it went from, if there was, out of 1 million people, if there was 100, or there was, it went to 140 or whatever that increase was. And so it was very misleading. In fact, we had Kelly Halverson from one of the insurance carriers that we show, that we use. And he said we'd have to have 20, what did he say? 20.
Yeah, we'll be conservative because I can't do the quote exactly, but it was at least 10 years of this increased mortality before the insurance companies would have to really markedly adjust,
change costs or anything, or mortality. It wouldn't affect mortality.
They're playing such a long game.
They're playing a long game. I mean, that's the whole thing, is they can do that and we can't, right? We get one life and we can't use 40-year bond laddering and things like that. We just don't have time.
We don't have the purchasing power that they have.
Exactly. And by the way, we don't want to do that. We want to buy real estate and businesses and cash flowing assets, because putting our money for long term, if you think about a life insurance contract, a whole life insurance contract isn't profitable to the company for around, every company is going to be a little bit different, around 20 years. And we can't do that. I mean, you couldn't run a business and hope to be profitable 20 years from now, but the insurance company can't, because they've got thousands and thousands of policyholders that are just now becoming profitable. So, we get to use the insurance company's strength and time horizon to our advantage.
Yeah, that's awesome. All right. Does death benefit decrease if there is an outstanding loan balance at time of death? And you said this earlier in another answer, but we'll give this some attention. What happens to loan if policy is collateralized at time of death? This is awesome.
So yeah, this is what happens is, let's say you had $2 million worth of death benefit and you had a $500,000 loan. All right. And you had a cash value, what you had, doesn't really matter what you had. Let's say you had 500,000. You had it all loaned out. Okay. Well, your family is going to get 1.5 million. Remember, tax free. Okay. And that loan, it wipes out the loan because the loan's gone now. Right. And so instead of getting 2 million, which the face amount says, hey, you collateralized your cash value and you took the insurance company's money and you went and did something with that. You lived off of it. You created income. You bought real estate or businesses or whatever it was. And we're just basically calling the loan at your death.
So you could take 500,000, go buy 2.5 million of real estate. Right. Generate that income that comes off of that. If it's 5%, it'd be 125,000 a year. Right. And it's 8 o'clock. That was good math.
That's
for 8 o'clock.
Good. Yeah. Cash on cash, 25%. That's pretty good. I mean, and by the way, that's not like hot in the sky. It's not guaranteed. Yeah. We're not giving you real estate investment advice.
But here's the thing. When you pass away, that loan's wiped out. Your estate gets the 1.5 million tax free. And you still keep the $2.5 million of cash flow assets.
Yeah, they don't come get those.
No.
There's no collateralization of that. And think about that. And, if anybody that's seen us draw out the ledger that we use, and we're talking about the three things that make up the infinite banking system, is you have your policy, which is your money pool. You have the assets that you're going to go buy. Mm-hmm. Now, what are you going to go buy? That's one of the reasons that we do our podcast, is to introduce you to experts that have invested in real estate, businesses, all kinds of things. And by the way, so many different facets of real estate, so many obviously facets of business. Yeah. And the real estate is a business. When somebody says I'm a real estate investor, Logan Rankin, I like the way that he always says it. He says, no, I'm in the real estate business. Yeah. So we're all business owners. We should run our house like a business, right? Our finances.
Yeah. All right, cool. So whoever asked that, I should have said this after we answered our last one, but if we didn't answer your question, if you got a follow up on that, type it in there. But all right, here's the fourth question or fifth question we got. What happens if I can't pay premiums?
Okay, that's a great question. Now, if you can't pay premiums, there's a lot of different options. Now, remember something though, too, is the premium that is due is just the base premium. Okay, so like the examples that Nelson Nash uses in his book, the base premium's around 40%. Okay, there's a reason for that because that's right on the MEC line. And anybody that is interested in this, like Nick said, if you go to the Becoming Your Own Banker course on the community, or you go to where else did we do that? The spectrum of efficiency.
It's on the YouTube channel.
On the YouTube channel. But when the MEC line, okay, without using a term rider, is about 60% goes into PUA, which is not a premium. Okay, it's you get to put that money in there in the PUA dollar for dollar. So it's just like going into your checking account. You put in $1, you have $1 available, and you have a little bit more than $1 of death benefit.
If you do that, what's your cost?
Let's see, if I put in $1 and I have $1, so zero.
It's awesome.
So, and now on the premium side, okay, so let's just use $100,000. The reason we use $100,000 is it's easy to see the percentages, right? So if I put 60 grand in or 60% on the PUA side, that's never, but it's I get to put it in there if I want to. And by the way, I get all year to do that.
Yeah.
I could wait till the last day of the year and I could still put the whole 60 grand in. Okay. But on the $40,000 side, okay, that's the premium. Okay. So I somebody would say, well, I have to pay $40,000. Well, okay, let's look at it this way. You put in $40,000, right? And you could put it in monthly. You could put it in annually. It could come from the cash value. You could use the PUA. You could surrender PUAs to pay it. And a great example of that is the equipment financing example. And on page 54, the example is not showing any infinite banking. It's kind of like the way that an insurance agent with a Northwestern Mutual or New York Life or somebody that doesn't know anything about infinite banking, the way that they would sell a life insurance contract. Yeah. But they like to sell it for a limited pay. Because they don't do infinite banking, they don't understand it. They don't realize that you want to pay those premiums as long as they will let you. Okay, because when I put in $1 and I get $1.50, okay, anybody that doesn't want to pay those premiums, let me know. I'll buy. Oh, no, I'm not going to say I'll buy that policy. I'm not supposed to do that, but I would buy the policy if they would let me. Okay, so those premiums could come from cash value, all different things. So I have to pay those premiums. But think about this: after the first couple of years, when I put $40,000 in that bucket, that whole life bucket on the whole life premium, I have more than $40,000 to spend to go use. Okay. More, the insurance company is going to give me more than the 40,000. So Nick, you write me a check for 40,000. I turn around and write you one for 60,000. Any way that you don't want to write me that check?
I'm just only curious, can I make it for 4 million?
Well, you know what? If you build your system big enough, then Nick, you can. But most of us don't start off that way. But once you get that concept and you understand, so I think the question, there's a lot of flexibility in paying those premiums. Mm-hmm. And I will tell you what, I will promise you, it will become more of a challenge because that money will, if you go buy cash flowing assets, that money will flow back to you faster than you can get it in the insurance contract. Yeah. That will be your problem more so than do I have to pay these premiums or where do the premium payments come from? Yeah. And I say that because in all of the years that I've been doing this, no one has ever said to me, Jim, why did you make me put so much money in this? I think I put too much money in there. Here's what they always say. And I can tell you, there are people on this call right now that I look at and I know I've heard it from these people on this call. Jim, Nick, why didn't you make me put more money in this? Yeah. Because we don't do that.
Yeah, that's funny. Hey, we got somebody who wants to chime in here. We got a lot of great, we got some other questions. We're going to get to them here. If you have just joined, there's a couple new names have joined. joined. Type in your questions, raise your hand. We're going to get to them here. All right, let's let Greg talk here. Greg, you there?
I am here.
Oh, the man, the myth. How's Virginia Beach tonight?
Great to hear from you. No, I actually was raising and lowering my hand to agree with what Jim was saying about never saying, wow, why did you make me put so much money into this policy?
I know. And Greg, I appreciate you saying that, because I know there's sometimes people that are new to this and they think, well, I always know when somebody doesn't get it, Greg, is when they say, how much do I have to put in here?
Right.
When they get it, somebody like you, and they say, hey, how much can I put in here? I mean, how much money can I flow through this thing? And then I go, okay, these guys got it. But by the way, we all start and wherever we start. And some of us get to that point where it's like, well, how much money? I want to get started, but I still don't really understand. So like, how much do I have to put in here? But you'll get it, right, Greg? I mean, it just takes a little time.
Yes, sir. Yeah, it honestly, I was like you, Jim, brought up in the financial securities industry, and it took me a while to figure things out. But getting a broader scope and getting a broader picture of what infinite banking was all about just really changed the paradigm with me. And I mean, now we've got our policies efficient, and we're working with them, and they're working for us, and
awesome.
It's amazing.
It's been awesome to watch you grow with this, and thanks for letting us have a front row seat to watch you just take off.
Amen.
Yeah, we were complimenting you this morning in our coffee meeting, just to let you know, because it's fun to watch. It just changes your life, and I know it's changed your life, and we love to be a small part of helping you change your life, because you've taken off and done it, and it's just really fun to see, because we have to break away from the herd, and you definitely have done that, and it's fun to watch.
Anything else, Greg?
No, sir. I just want to chime in and concur with everything that you were saying.
All right, buddy. Thank you.
Thank you.
So
another question.
The other thing I wanted to say about that is that question implies that you're getting a bill like everything else, right?
Right.
And the thing I would encourage you to read is read Nelson's book, Building Your Warehouse of Wealth. You can get that. You can go to infinitebanking.org. You can probably find it on Amazon. But just remember, your money is going to reside somewhere. Right?
Yeah, right.
Like, so let's use your $100,000 example. Somebody you're going to bring in more than 40,000 a year. Like that's just that's not an option for me to not, right?
Yeah.
So what is
got
that?
4 kids. There's no way.
33 a month is that base premium if you had to break it up into monthly payments. And if every month I'm flowing that through there and I'm getting at least 33 a month, right? And it's for that little, maybe it's a lean season. Maybe that is all you bring in. But hey, if you put in 40,000 and you got 60,000 to use, doesn't that help bridge the gap better in your life, right?
It does. And think about this, that's around year 10.
Yeah.
What about if you started when you're 40 or 50 or even younger? I mean, and you're 65, 70, you're putting in $1, you might have $3 to use. Do you think that might be helpful when I'm 70 or 80, or when I'm just, when I want to use this money, or maybe I just want to grow it. But and to somebody's point here, and I'm sorry, I can't see who was asking that question, but in the beginning, it isn't one-to-one. Like in the first year you put in, let's use my $100,000 example, you might only have 60 to use. It's normally a little, like maybe 62 or something like that. But let's say you have 60 to use. But if you're using it for cash flowing assets, you're going to make that up so fast. And what the mistake that people make, is that Nathan that asked that question or that question? Okay. Yeah. So the mistake that people make is they try to make that base lower so that first year cash value is higher. And it's easier to sell, by the way. That's why these marketers do it this way. But when I get to year 10, I don't get that same leverage. I don't get to put in 40 to have 60. I get to put in 10 to have 15, and that ratio, and so it is like the first year 2 and 3, and is I think with the death benefit, the cost of the death benefit, depending on your age, I'm going to call that almost breaking even. And then by year 4, you're breaking even if you're not rated. Okay. And then by 5, you're leveraging and you never look back. So yes, there's a cash drag in that first year. And if we wanted to say there's a slight cash drag in year 2 and 3, okay. But then I'm going to start to leverage. And and by the way, this is just how the insurance contract works. It is not infinite banking, and it sure isn't infinite banking with cash flowing assets. Because once I do that, I'm going to make up that cash drag so fast, it's unreal. And if you go back to page 45, and we've got videos to explain this, and because, people, the first time I read it, the first 3 times, I'm telling you, I did not get it and understand it. And Nelson showed it to me, I don't know how many times, and I would consider myself to know everything about that page. Okay, pretty much. I've forgotten some things. Don't hold me to everything.
Hey, this video is in the first. It's the first video of section 3 of the Becoming Your Own Banker course.
Perfect. If you watch that video, you'll see that when I explain that, nobody goes back and says, "Hey, but in year 1, CD's sister had $5,200 and IBC sister only had $1,900." Because when we show the system, and once we start banking, we show that at age 65, putting the same amount of money through their system, the IBC sister has $706,000 more. Now they put $5,000 in for 7 years. They financed $10,550 cars. Okay. And she ends up with $700,000 more. Over 700,000. So what would happen if I put 100,000, $1 million? And what would happen if I bought cash flowing assets? Because not only do I get what is on page 45, but I get what all the money that those cash flowing assets are making. Excuse me.
Hang in there.
I know. Late for you. Well, no, I was getting warmed up now. I don't, now we're going to have to go watch a baseball game or something at 9:00. Okay. So
you wrestle moose.
It's all of those. I don't have that much energy, but it's all of those things together that make the infinite banking system. And so I want you to, and I'd be happy to on off air go through with you that, because I want you to get past that worrying about that one-to-one ratio in the very beginning. And I'm not saying you are. Okay, I'm just answering the question, but I know people sometimes do. Is I can show you and I'll draw it out. I'm telling you, it's amazing, and you'll forget about that first year in no time. But the reason that Nelson did it that way, and the reason we do it that way, is because we want to think long term. Nelson was trained as a forester. He taught us to think long term, and thank God he did. Because if I just said, well, look, I'm losing whatever percent the first year, and if I never got past that, my life would be a lot less amazing financially than it is now.
So Nelson and I hit it off from an aviation perspective, because a lot of you know that I used to fly airplanes around the world. And Nathan, I want to kind of just build on this just ever so briefly. Like an airplane fully loaded up is not very efficient. Okay. And Nelson uses this analogy in the Becoming Your Own Banker book, but the whole life policy, the expenses are front loaded, essentially. So remember, we already said the insurance company is not going to be profitable with this for roughly 20 years. They're playing the long game. But the airplane, let's say we fly for 10 hours and we're about ready to land and we have to do a go around. Okay. It's the same exact airplane, but if I go max power, that airplane is a rocket ship. That same dog airplane that we tried to take off with on a hot day in Hong Kong is now a rocket ship on a go around. Okay. So this is the same thing that's happening with the whole life policy. Okay. It gets more efficient the more we burn off the weight. We're burning off the expense of the policy. So year 1, I might put in 100,000 and get 62,000 to use. But in year 10, when I'm just paying the base premium, I put in 40 and I get 60 to use. It's getting more efficient. Year 18, maybe I'm not too far off on some of these years, but year 18, I put in 40, I get 80 to use. Year 25, I put in 40, I get 110 to use. Like I'm going to be beg, borrow, and stealing for that 40,000 come hell or high water to put that in there, right?
Nick, let me ask you a question. So if when you were flying 747s around the world, they were empty in the back, right?
Never.
Well, but it would fly better if it was empty.
It would. It just doesn't make any money.
Oh. So what would be in the back?
I guess revenue.
Assets, right? Those are assets to the freight company.
That's right.
Right. So again, just remember that and think about that. We're going to go buy assets. And I keep using real estate because, let's be honest, there's opportunities in real estate no matter what the market is doing. And so real estate is constant. More billionaires are made with real estate than anything else. So I like to use real estate as an example because everybody can relate to either wanting to do that or doing that, right?
Yeah. Thanks a bunch for asking that question because
that's a great question.
There's a lot to it. If you've not read Becoming Your Own Banker, highly recommend you get it. Go to infinitebanking.org or if you watch the course or if you're working with one of the coaches or Jim or I, just ask us and we'll help you. But I also want to say thanks to Greg too for answering a question. And we'll just ask this out in the open for everyone. Doreen asked, how soon after originating a policy can you start doing IBC? And the reality of it is, I'm going to just give you the real safe, conservative answer and say about 2 to 3 weeks. Okay. There is some things that happen in the background with the insurance company establishing the policy and making sure there's not money laundering going on. Like they're just kind of regulatory things. But once we're established, when we make a premium payment, as soon as we can prove it cleared our bank account, we can take a loan on it. Now, Kelly's not on here, is she tonight?
Yeah,
but our office manager, it's kind of
a challenge for her. And we can get, in some companies, we can get the money the same day.
Yeah.
So, okay, now we're making sure Kelly is. That's just a lot of work for Kelly, but it's okay. That's why she gets paid the big bucks.
Yeah. So just here's the thing, Doreen, motion's the law of God. If air doesn't flow through your lungs, you die. If water doesn't flow, it's stagnant, it's poisonous. If money doesn't flow, it's dead. And listen, we're practicing what we preach. The insurance companies we're showing people, or our insurance companies we have our money with, we're taking loans. We're putting in motion for cash flow assets, financing everything under the sun. And so we want to be able to capture that right away.
And also, unless I'm reading this wrong, I don't have the best eyes in the world, but I think it's a reverend, right? So if you look at the parable of the talents, okay, now I'm not going to give you a Bible lesson, Reverend. Okay, I'm sure you can give me one. But the parable of the talents, they put the money in motion. The person that got 5 talents, and again, my calculations are going to be off, but what they were about, a talent was equal to about 1 year's salary or 1 year's income. So let's just say, in today's world, they said it was like 180,000, 100. Yeah. I've heard numbers like that. So 5 talents is a lot of money, right?
Yeah.
But they put it in motion because, like Nick said, motion is the law of God, and they doubled it. But remember what happened to the servant that buried the talents in the dirt?
He got smacked in the head.
They got smacked by the master. Okay, and if anybody on the call doesn't know who the master and who the servant is, we'll stay on it for a little bit and help you with that. Okay, so we are called to put our money in motion, because when I go buy multifamily real estate or I go buy a business, I'm serving my community. I'm providing safe, clean housing, or I'm providing electronics. I'm providing a trash service for us. We're going to be providing car washes. We're serving the community, right?
That's right. That's right. So thanks.
Great question.
Doreen had another question. What are the most important features needed in the policy to give it the best use for IBC? I've never had insurance and don't actually care about anything except using it for IBC. I'm also starting out on a low budget, but I'm 58 years old. So we've covered some of these things before, and we're happy to address it here. Just know that we are 100% practicing what we preach.
So I want you to think about something too, because we have some clients that have been doing infinite banking for a long time. No kids, no heirs, plenty of cash, no debt, anything else. But you know what? They really care about their church. Yeah. So this couple in particular, they happen to be Catholic. They care about their church. So all of the death benefit is going to the church. So it works whether you go to synagogue, whether you go to a non-denominational church, where they will take your money, right? Because they're going to go out and serve the community.
That's right.
They're going to send out missionaries and all kinds of great stuff. So you just think that death benefit doesn't have to go. It can go to whoever you want it to go to. It can go whatever cause you want it to go to. But what I call, by the way, I'm 57. What I call 58 is, and 57 is halfway. Okay. So, and by the way, Nick's going to laugh because I'm going to keep calling it halfway.
Just like old's 10 years from now. Yeah. It's always 10 years from now.
Yeah, that's right. It's always 10 years from now. So, just know that the features that we look for, non-direct recognition versus direct recognition. One of the companies we use, they give you a choice. Now, there could be some rare interest rate dividend environments or ratios that maybe direct recognition would be better, but it's going to be very, very slim very few times over the life of the contract. Non-direct recognition means we don't affect your dividend based on your loan activity, which we're going to have loan activity, right? So that's what we want. So number two is we look for insurance companies that have low interest rates on their loans, because we're going to be taking loans. Companies that can get us the money quickly, companies that embrace infinite banking. There's one major insurance company out there, and they told their agents, if you hand out that book right there, becoming your own banker, we will terminate you, because we don't want you to encourage people to use their policies the way it's written. That's not what they said, but that's what the message is, right? Because the policy is written to allow loans. So we look for that. We look for financial strength, not ratings, by the way. Okay. Financial strength, statutory reserves, NIAC ratios. We want to know if they paid everybody everything that they owe them, how much would they have left over? And why not? Why wouldn't I want to go? And there's the quiet company out there that talks about their ratings and everything else. And by the way, we got companies that have just as higher ratings as they do, but we have companies that have better financial strength than they do. Now, back in 2009, the largest insurance company in the country, and they were rated Max. The top ratings for every rating firm, the top. 30 days later, they were insolvent. What happened to the greatest financial strength? And what it was is they had a derivatives division, 20 people. AIG is the company, still the largest insurance company in the United States, because everybody on this call, bailed them out. They were too big to fail, right? And they had 20 people in London, England, in their derivatives division that almost took down the largest insurance company in the United States, while they had the top ratings of every rating firm. And so ratings are for sale. Some of the insurance companies that we use that don't sell derivatives, don't sell other ancillary things, the insurance company or the companies say, well, you're not diversified enough. Whole life insurance is based on actuarial science. It's not a guess. It's not an art. It's science. You tell me I graduated in high school in 1982. If you're 58 years old, that's close. And there was 1,000 kids in your class. We can get an actuary on the phone, not tonight, but tomorrow, and they can give you an exact number of how many of those kids are dead.
All right. We're about out of time, but I want to touch you because you're on a roll.
All right.
But we missed a couple things.
Okay,
the big ones, like,
right.
Hey, we're going to be using a mutual company.
Yes.
Okay. We're going to be using a company that's been around for at least 100 years. We're going to be using a company that has paid a dividend for at least 100 years straight. And then we tend to gravitate towards the companies that are centrally located in the United States. And a big reason for that is they just have lower expenses. It costs a lot less to run a business in Lincoln, Nebraska, or Cincinnati, Ohio, than it does out of Springfield, Massachusetts, or New York City. That's just logic, right? So since we're using a mutual company, and the reason we're doing that is only the policyholders are owners of the business. So if I own the business, I want the overhead to be low, right? And meet all these other great highlights that Jim shared. But I want to, you have anything you want to add to it? Because we are coming up to the end of our time here.
Mutual companies, absolutely. I mean, insurance companies are required by law to distribute the profits to the owners. So if shareholders own the company, like in a stock company, then they're going to get the profits. If policyholders own the company, like in a mutual company, then they're going to get the profits. But so why are companies domiciled in New York? Well, before Zoom, before we were all online doing this, New York is the #1 insurance market in the world. That's why. Yeah. Well, that doesn't matter anymore.
It doesn't.
Right. So, you know, and by the way, we'd be happy to answer more and more of these questions. And I love these questions. These are great questions. And I want you guys to know that you can, every time that we have these, you can ask any question you want. I mean, is there any question we didn't answer?
Hey, we can stay. Just one, Doreen's last question there. Do you guys use Forrester?
So Forresters, we don't use Forresters. I mean, we could, but when we look at the guarantees and the current cash value and the loans and everything else, we just haven't used Forresters. I mean, there was a great marketer that went from Lafayette Life Insurance to Forresters. That's where Forresters is actually, they changed their policy. And the CEO, Eileen McDonald, I think she's still the CEO. She was at MetLife at one time. And so she's got a long insurance background. But I think there are better options out there. And offline, I can tell you why, because I don't really want to, anything I say is going to sound like negative to Forresters. There's nothing wrong with Forresters. If you have a Forresters policy, we can use it for infinite banking. And we'll show you how. So that's what I would say.
Yeah. We're not married to any company. No, these companies don't pay us any different. We just genuinely, we'll just show you what we're doing. And that's really kind of what it comes down to.
Yeah. And let's end with that, Nick, we'll give you our business model just because some of you don't know, but anybody that's on here that's a client, they know you never pay us any money directly. We set up the insurance for you. All of these insurance companies pay somebody a commission to do it. You might as well get the coaching and everything, unlimited coaching for free. And anybody that's a client will back that up 100%. And so you never pay us directly. Number 2 is wherever you start. Okay. And we talked about this earlier today at coffee again, is whether you started at, we have people that start less than 100,000. We have people that start over $1 million. We have all over the place. We have a few $1,000s people have started. Yep. But wherever you start, if you started at $1 million a year, you will grow it.
Yeah,
absolutely. 100% guaranteed. So you're going to continue to buy more insurance contracts because we want to sell you more and more insurance? No, because we want to show you how to expand your system more and more and more, right? That's where the coaching comes in. And the third thing is that we're never going to ask you for referrals, but all of our clients give us referrals. And the reason is that once they get it and they get excited, and I think you could tell in Greg's voice and the enthusiasm, I guarantee you, I don't know the number, but it's a lot of how many people that he's referred to us. We've never asked him once for a referral. That's our business plan in a nutshell, totally transparent. And
that's it.
That's it.
All right. Hey, thank you everyone for showing up tonight. Great group, great interaction, great questions. We got more of this coming up. We'll have the schedule out for the next few weeks here, probably in the next day or two. I believe these are being posted to the community tomorrow. Maybe it'll be Friday, the replay, and share it with people. Hey, this is a gift, right? We evangelize this. And we're happy. Don't keep it to yourself. Share it with people. It's financial freedom. And if we do this the right way, it sets up a stress-free way of life. Thanks, everyone.
Thank you.